Trump versus Powell takes a dark turn. Are Indian markets back in vogue again? And why FedEx management continues to confound me. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. First of all, belated Easter greetings, guys. I just realized that last week when I recorded this, when I should have wished you Easter, but nonetheless, belated Easter. I hope Easter greetings. I hope all of you had a lovely Easter break and an extended holiday here in the UK. We had even yesterday was a holiday. So if you are in the UK, if you're listening from the UK, well, hope you had a extended 4-day weekend and hope you guys had a lot of fun with your families. And hope there was enough laughter and delicious food during the weekend when you came back to the markets, so that when you came back to the markets, you were prepared to withstand the turmoil that continued. Pretty much it was as if markets had no Easter, markets were in no festive mood, let me put it that way. And this time, it was not just the tariffs. They continue. The drama continues with the tariffs. It was also due to a new chaos variable that I'd like to talk to you guys about in a little bit, just a little bit. And that chaos variable is the threat to the independence of the Fed, or the independence of the Federal Reserve. Before I go into more detail about that, a quick recap of the market action that took place last week. Once the dust had settled, the markets were in no holiday mood whatsoever, despite the fact that Friday was a holiday shortened week. They were in no holiday mood whatsoever. It was yet another week with where all three indices finished in the red. Dow down 2.7%, S&P 500 tumbling 1.5%, and the tech-heavy Nasdaq down 2.6%. I mean, these days it's massive swings. Yeah, you had a streak where the S&P barely had a 2% decline. Now you get 2% decline every other day, weekly, and you get probably gains every other day as well, and then just net it all comes down. The markets just end up in a pretty tough spot by the end of the week. Such has been the pattern. So lots to discuss. So let me quickly welcome you to the Doctor's Weekly Snapshot and talk to you about this new headache for the markets, the new chaos variable that you need to incorporate, one that cannot be modeled, unfortunately, and that is the threat to the very foundation, the threat to the very independence of the US Central Bank, the Federal Reserve. It all started last week when Fed Chair Jerome Powell spoke at the Economic Club of Chicago, where he expressed concern about all the tariffs. I think I'm losing count here, but let's take a look at what all tariffs that have been in place so far. So let me just give it a go. You have steel tariffs, 25%. Aluminum tariffs, so steel and aluminum combined 25%. You have auto tariffs at 25% unless you are exempted from the USMCA. Unless you're certain parts of, as long as it's part of the USMCA agreement, everything else is 25% tariff. Then you have China, which currently stands at 145%. I don't think anything else has been added since Easter break. US on China 145, China on US 125. And then the so-called reciprocal tariffs that have been paused for 90 days, slightly less than that now. But even within the reciprocal tariff, the baseline tariff of 10% on across all nations. Did I get that right? Even if I didn't, it doesn't matter because such has been the tariff-related chaos. So basically, what Fed Chair Jerome Powell did when he spoke at the Economic Club of Chicago was the concern. He expressed his concern about all the tariffs, putting pressure on the Fed's mandate, the dual mandate of stable prices, strong employment. Chair Powell argued that tariffs are, and it's his quote, not mine, highly likely to generate at least a temporary rise in inflation, and the inflationary effects could be more persistent. Regarding rate cuts, and this was probably the catalyst for what was to follow, Chair Powell suggested that the Fed was well positioned to wait for greater clarity before considering any adjustments to our policy stance. So he basically said, no rate cuts, no imminent rate cuts needed. They're well adjusted, they're well positioned. They were adopting a wait and watch strategy and all of that. Markets digested, took that in stride. They finished the week. They finished the day in the red after these comments, but it was not kind of pandemonium. Pandemonium happened a few hours later. So the comments themselves, while not helping the market's cause, were nothing new. Chair Powell has mentioned this tariff and inflation effect multiple times already. Other Fed officials have done the same. So it was really not something that was surprising to the markets. What really drove the markets anxious and terrified when they reopened on Monday was actually the latest comments from President Trump on the Fed, and more specifically on his friend turned nemesis, Chair Powell. Remember, President Trump is the one who nominated Chair Powell to the board during his to the chair position, to the Fed chair position during his first term. And ever since then, towards the end of the first term, that friendship has soured, and now it's full-blown war. Last Thursday, President Trump, full-blown war. Okay, I don't want to spook any of you guys. Verbal war. Okay, verbal joust, whatever you want to call it. Last Thursday, President Trump lashed out at Chair Powell on social media, saying he's too late on cutting rates and that Powell's termination cannot come fast enough. Not my words, it's President Trump's. Yeah. President then doubled down on his attacks on Chair Powell on Monday when markets reopened, calling him Mr. Too Late and a major loser. Not every day you get the president of a top nation, of a developed nation, just smashing and abusing and verbally abusing his central bank's chair. But here we go. We live in a very different world today. And President Trump also demanded that the Fed lower interest rates now. Now was in all caps, which has become a trademark of President Trump when he tries to emphasize a point. President Trump's battle with Fed Chair Powell is nothing new. Okay, that's the first thing you need to understand. Towards the end of his first term, like I'd mentioned before, he had criticized him on numerous occasions. But what was worrying for the markets was a report from the Wall Street Journal released last Thursday, which said that the president has been engaged in conversation for months about the possibility of firing Chair Powell. While former Fed Governor Kevin Warsh, who is the rumored favorite to replace Chair Powell, whether he finishes the term or not, if he does finish the term, which is the likely case, then Kevin Warsh is considered to be the favorite, red-hot favorite to replace Chair Powell. So while former Fed Governor Kevin Warsh and Treasury Secretary Scott Bessent both have advised against the idea of firing Chair Powell, citing the potential impact on global markets with the loss of Fed independence, the renewed attacks on Chair Powell and comments from certain White House officials that the president is studying the possibilities of whether he can get rid of Chair Powell for cause was the latest catalyst that has driven fear into the markets. Not to mention, this comes at a time when the threat of a recession is very, very high. So the fact that you have a scenario where a central bank, which needs to be at its full strength to tackle any fallout from a recession or mitigate the damage done by any potential recession or slowdown, could lose its independence and weaken, naturally causing further chaos, added a new element of uncertainty that was simply too much for the markets to digest. So that's the context that drove markets into further turmoil, not just yesterday, Monday, but also heading into the Easter holiday. The question investors have to ask, though, and they have already done to an extent, is whether it is possible at all for President to remove Chair Powell, a man who only has one more year left in his tenure as the Fed chair. He will continue to be a governor, but after that until 2028. But he is Fed chairman role finishes in May 2026. So question is, does President Trump have the authority? Technically, no for now. But things could change. And this is because the Supreme Court is revisiting the 1935 Humphreys executor decision, which currently prevents presidents from firing certain federal officials, including Fed governors, for purely political reasons. Under the Federal Reserve Act, Fed governors are nominated by the president, confirmed by the Senate, and serve 14-year terms, with the chair serving a concurrent 4-year term. So Chair Powell is right now into his second 4-year term. They can only be removed for cause. That is very much so. After all, they're humans. Humans commit crime. Humans, you step out of their order, of course, they're fired. Right? In any business sense. The Trump administration has urged the Supreme Court to overturn this 1935 Humphreys executor, arguing that it infringes on presidential control over the executive branch. Recent firings of independent agency officials by President Trump have brought this issue to a head, and the Supreme Court is finally considering the legal merits of these demands. Here's the catch, guys. If the Supreme Court grants the president at-will firing power, the Fed's independence could be severely undermined, making its governors akin to other political appointees, such as the Treasury Secretary. Remember, Treasury Secretary can be fired by the president. It's at-will employee. The Fed, the bastion of independence, it's supposed to operate under full independence, from any sort of political intervention, if the Fed governors all become at-will employees, then all chaos would break loose, right? Therein lies the main real reason behind why markets are terrified and why you saw a sell-off, yet another epic day of sell-off yesterday as well. When President Trump, towards the end of his first term, lashed out at Chair Powell, markets were not this worried because there was no question of the Supreme Court being involved. This time, it's completely different, and the independence of the Federal Reserve really is at play. While Chair Powell has stated that he does not believe the Supreme Court's decision will affect the Fed, the court's conservative majority has historically been skeptical of the 1935 Humphreys executor. I keep saying 1935 because it's not been invoked in a long time. Yeah, things are all changing under this new administration is all I'm saying. Some scholars believe that the Supreme Court may still find ways to protect the Fed's independence, even if the president is overturned, even if the Humphreys executor is overturned, but this remains highly uncertain. Here's what happens if Fed's independence is compromised. If it does become compromised, monetary policy could focus on short-term political goals such as lower interest rates before election, potentially at the expense of controlling inflation. Historical evidence has shown that independent central banks are associated with lower inflation. For example, when the Bank of England gained independence in 1997, expected inflation and the bond yields dropped significantly. Politicizing the Fed could also undermine confidence in the US Treasury debt, one that has come under power, something that has come under fire in recent months or recent weeks, especially as the government faces large deficits and needs to issue significant new debt. A compliant Fed would allow inflation to erode the value of their holdings, leading to higher longer-term interest rates and a weaker dollar. Now, tariff-related uncertainties were already driving fear into investors, so much so that many on Wall Street are saying that there is a buyer's strike in the US markets. Nobody's willing to buy anything. Right? Any dips, nobody's willing to willing to buy any US assets, let alone stocks, bonds, whatever you want to call it. The instability is also raising concerns about a possible shift in the global capital flows away from US assets, threatening higher borrowing costs and the dollar's very own reserve currency status. And now you have the Fed's independence at stake, which to me, ladies and gentlemen, is far more dangerous than any trade war. Do investors expect cooler heads to prevail eventually, which would result in Chair Powell finishing off his term until May 2026? Yes. Will they bet their money on it, or can they bet their money on it? No. Therein lies the problem. With that, let's head to the next segment. The doctor goes home. Where finally I have some positive news. It's been pretty murky episodes recently, has it been? Whether it's India or US, whatever it is, it's been pretty murky episodes. But such has been the game, right? Not supposed to be. Things can't always be rosy. Things can't always be hunky dory. Some things, So you gotta adapt to it, right? So I bring some positive news from the Indian context. Okay, as the rest of the world goes through one nightmare scenario after another, one fueled by tariff-related uncertainty. Is the Indian economy bucking the trend? That is the question that we will be addressing this week. If the developments of the week gone by were an indication, then the answer seems to be leaning towards a resounding yes. I told you. Coming with positive news. First, we got the March retail inflation data, which was so good that it not only vindicated the Reserve Bank of India's decision to cut rates and move into a more accommodative stance, but it could very well provide the fuel to the central bank to undertake more rate cuts in its next meeting and the meeting after that as well. More specifically, March 2025 CPI inflation was 3.3%, down from 3.61% in Feb and well below the RBI's target rate of 4%, well below. It's closer to 3 than it's to 4. It's fantastic. It's the lowest inflation rate recorded since August 2019, reflecting a sustained trend of easing price pressures over the past 5 months. On a fiscal year basis, inflation declined to 4.6% in FY25 compared to 5.4% in FY24. Okay, while the annual inflation is above the Fed's target of 4, first of all, it is within the range of 2 to 6, and that's a substantial decline. 5.4 in FY24, now 4.6 in FY25. The main contributor to the lower inflation rate was a sustained seasonal correction in food prices. Food inflation dropped to 2.7% in March, the lowest in over 3 years. Vegetable prices saw a notable year-on-year decline of 7%, while pulse prices dropped by 2.7%. The high base effect from last year's elevated prices also played a role in moderating the inflation numbers, and this effect is expected to persist for the next 3 to 4 months, which means the numbers should keep improving in the coming months. Rural inflation fell to 3.3% in March from 3.8% in Feb, while urban inflation edged up slightly to 3.4% from 3.3%. The decline in both headline and food inflation was more pronounced in rural areas. All in all, ladies and gentlemen, fantastic report, one that should definitely bring some cheer to the Indian investors as it gives the Reserve Bank of India more impetus to push ahead with its rate cuttings agenda. We also got the wholesale inflation data last week, the producer prices or PPI in the US. That's what we call the wholesale inflation in India, which was also positive and growth friendly. India's wholesale inflation measured by the wholesale price index. So producer price index in the US, you have the wholesale price index in India. WPI eased to 2.05% year over year in March 2025 from 2.38% in Feb. I don't know why I keep saying 2025, it's 2025. Just keep changing a bit there. The WPI figure came in below economists' expectations of 2.5% and marks the lowest rate in 4 months. I love this. Lowest. It's beautiful. The moderation in wholesale inflation was primarily driven by a slowdown in food price increases again. Wholesale food inflation dropped to 4.66% in March from 5.94% in Feb. Notably, again, vegetable prices, the new heroes from nemesis, from villains to hero. It's been a turnaround story. Vegetable prices saw a sharp decline of 15.9% compared to a 5.8% fall in nearly 3 times decline, which is fabulous. And it's attributed to improved vegetable production. Obviously, a higher production. I don't need to tell you that, but it's amazing to see a decline of 15.9% when you compare it to 5.8%. Such declines is exactly what should give investors cheers. I mean, like I said, investors have every right to cheer this report. But you got to keep in mind that the IMD, India Meteorological Department, has issued warnings about heat waves and rising summer temperatures. My parents are right now in India. They've told me how hot it is over there. So it's much hotter than usual. So heat waves, rising summer temperatures, they could push up vegetable and fruit prices in the coming months, potentially exerting fresh inflationary pressures. So not exactly 100% positive, but I wouldn't call it worrying either. I mean, for now, I would focus on the 15.9% decline in vegetable, 4.7% decline in wholesale food prices, overall retail inflation coming in well below RBI's target, all of that positive. When it's positive, you got to be positive, right? You can't, I mean, this is the thing. You can't be when it's negative, you say it as it is. No emotions, just based on facts, isn't it? It's fact-based, or as the US Fed likes to call it, data dependent, right? Right, that's on the economic front, so inflation data. There was also a lot of cheer on the tariff front as well. Not tariff specifically, but on the fact that discussions over the bilateral trade agreement between the United States and India seems to be moving a lot faster than usual. Both nations are accelerating efforts to finalize the first phase of a bilateral trade agreement, with negotiations gaining momentum amid a 90-day pause on US reciprocal tariffs. So this 90-day pause seems to have, urged Indian officials to really go for it, use this time wisely. So it seems to be they seem to be doing that, and they seem to be definitely heading in the right direction. The proposed deal currently under discussion is structured across 19 chapters and will address a range of regulatory issues, including digital taxation, tariff reductions, and other non-tariff measures. The framework being established will also outline technical aspects such as rules of origin and customs procedures, though specific offers and commitments are expected to be tabled only in later stages. Now, the talks are taking place at a time of heightened diplomatic activity, including a visit by US Vice President J.D. Vance, who has arrived in India, had a productive meeting with Prime Minister Modi yesterday. He will be in India for another couple of days, including he does a personal trip as well. But I think there will be one today also, will be diplomatic talks. So it's happening right now. Simultaneously, India's chief negotiator, Rajesh Agarwal, is set to lead a delegation to Washington, D.C. for 3 days of technical talks starting April 23rd, which is tomorrow, guys, where both sides will further develop the terms, hopefully, everything's hope, right? With this, everything's hope. This tariff war, one thing this trade war has taught, everything's based on hope. You hope. You can't simply say, yeah, this will happen. Unless it happens, you got to say, okay, hopefully it might happen. So both sides will hopefully further develop the terms of reference and discuss the level of ambition for the deal. Remember, the target to wrap up for the bilateral trade agreement was fall 2025, but thanks to the 90-day pause on the reciprocal tariffs, when one factors in the latest developments, it does appear that things are moving a lot faster than initially expected. Keep in mind, I use the word things do appear. I'm not saying they are. You never know. There's this notion that there is a sense of urgency, and we're hoping that this sense of urgency really, does the job. All of this, ladies and gentlemen, the inflation data, the positive on the tariff front, all of this has led to a lot of positivity. More importantly, momentum in the stock markets. Banking and auto stocks more recently have been on an absolute tear in particular, as easing monetary policy, strong earnings report, and hopes of tariff reliefs have all been strong tailwinds. In addition to RBI's rate cuts, easing inflation factors such as weakening US dollar and dipping crude oil prices have further supported Indian equities by improving macroeconomic stability and easing import costs. More importantly, the foreign institutional investors are back, and boy, are FIIs back with a bang. While they continue to be net sellers so far in April, lately they have been, pouring money back into the markets once again. Over a 3-day period in April 2025, foreign institutional FIIs injected an impressive 15,000 crores into Indian equities, sparking an absolutely sharp market rebound and renewed optimism on Dalal Street. The Sensex surged nearly 3,400 points during this window, its strongest rally in recent times, driven almost entirely by the influx of this foreign capital. And given all the factors that I've talked to you about this segment, there's every chance that in the coming months, they are likely to be net buyers. It'll switch from being net sellers to net buyers, which should turbocharge the markets even more. The weakening of the dollar and the declining crude prices certainly helped the case, but more importantly, the disconnect between the tariff policies in India and China for the foreseeable future should also be a key driving factor behind the comeback of the FIIs, the great FII comeback. Keep in mind, and I've told you this before, the Indian economy is still expected to grow at 6%, far outperforming any other major economy, including the US and China. Moreover, the tariff pressure on China is so much so that even China is now going on a charm offensive on India, as evidenced by the recent announcement of its willingness to open its vast domestic markets to more Indian goods, signaling a potential shift in the economic relationship between Asia's two largest economies. While I wouldn't read too much into it, China is China. I'm not going to read too much into it. They keep saying one thing and then it's the other. So not going to read too much into it, but it just goes on to show how much sentiment has shifted in the last few months, which can only bode well for Indian investors. Bottom line, when hope seems to be lost pretty much in every major market, the Indian markets seem to be a positive outlier. Been a while since I've said that. Recently, there have been so many strong tailwinds which have given investors every reason to pour money back into the Indian markets after a period of negativity. Inflation is easing. Monsoon season is expected to be much better than initially expected. RBI continues to aggressively move into monetary policy easing, and FIIs are back, and they are back with a bang. On top of that, Q4 earnings, especially financials, have been very strong. All this has changed this sentiment completely. Now, are there risks? Totally. Direction of the dollar, global inflation, and India's relative economic performance will all continue to be key determinants. And should cracks appear in trade negotiations, which most certainly can't be ruled out, I've told you it's never certain with the President Trump's administration when it comes to tariffs. So the cracks, potential cracks appearing in trade negotiations certainly can't be ruled out. And if they do happen, then I would expect to see pessimism immediately coming back. I don't think it'll even wait a second there. As such, I'm not going to say all guns blazing. I'm a perma bull in India. You guys know by now. You guys have been following, for those who've been following me 3.5 years, been doing this for a while now, guys. I'm a perma bull. Yeah, it's on India. But having said, despite being a perma bull, I'm not saying go all guns blazing into the Indian markets. All I'm saying is that the clouds seem to be slowly moving away, and investors can see a little bit of sunshine again in the Indian markets. The odds of the skies being brighter for the Indian markets going forward have certainly increased in the last couple of weeks. And all I'm saying as I wrap up the segment is investors, in my opinion, should certainly rejoice that. That's all I'm saying. And with that, I'm going to take you to the final segment, Dr. Dissects. We're going to take a break from all these AI beneficiaries that I've been talking about. Not because they've been absolutely getting pummeled. Every weakness is a buying opportunity when the names I've discussed, in my opinion. But hey, your money, your research, you got to do what you got to do. But I'm going to take a shift away. I'm going to shift away from from the usual AI beneficiaries I've been discussing over the last past few weeks. Talk about a company that's bang in the middle of the tariff war. Okay, the company I'm talking about is the industrial giant FedEx Corp, ticker FDX. Okay. Now, FedEx reported its Q3 earnings last month, and it was pretty much a mixed quarter, which has been a trend now. More specifically, Q3 revenues came in at about $22.2 billion, up 2.3% year over year, and beating analyst estimates by $320 million. Non-GAAP diluted EPS came in at $4.51, and while this was up 16.8% year over year, it missed analyst estimates by 12 cents. Both operating income and operating margins, however, bucked the recent declining trend and were up on a year-over-year basis, with operating income coming in at $1.51 billion, up 10% year over year, and operating margins coming in at 6.8%, which was up 60 basis points. Both these metrics are on non-GAAP basis. Citing continued weakness and uncertainty in the US industrial economy, FedEx once again lowered its FY25 outlook. This, unfortunately, has become a trend, ladies and gentlemen. I think I've voiced my opinion on FedEx multiple times, but this has unfortunately become a trend where they just keep simply lowering the guidance. I don't even know why they, it makes me wonder why management should even offer guidance anymore. To make matters worse, the updated guidance came in well below analyst estimates as well, which were already lowered ahead of the Q3 print. More specifically, FY25 revenues are now expected to be between flat to slightly below year over year, compared to the previous forecast of approximately flat. Adjusted EPS is expected to come in between $18 and $18.6, $18.60, compared to a previous forecast of between $19 and $20. The latest EPS guidance was also below the consensus estimates of $19.18. Now, I'm not here to discuss just the earnings number. I'm here to we do the takeaways as well. So the main takeaway is there's been a noticeable pattern emerging from FedEx's earnings call in recent quarters. A strong bullish tone from the management, even as they lower guidance every single time. This contradiction, I'm not just going to say this contradiction drives me crazy, but it is one of the major reasons why I'm starting to get frustrated. Crazy is probably, it's an understatement probably. I'm starting to really get frustrated with this company, and why the previous times I've talked about this company, I've argued it's always been a case of one step forward, two steps backward when it comes to this company. The management bullishness has always been mainly around its cost-cutting initiative drive, and there are valid reasons to be positive regarding this initiative. The company had set a $2.2 billion savings target for FY25, and the good news is that it seems to be on track to achieve this target, if not exceed it. The company's cost savings have been incrementally doing well with each passing quarter. Savings in Q1 total $390 million, increased to $540 million in Q2, and more recently, it is now at $600 million. So it implies that the company would need to achieve $670 million in savings in Q4 to achieve the total $2.2 billion savings target, which is a reasonable target in my opinion. So overall, with respect to the drive cost-cutting initiative, the company has been making positive progress. Moreover, the savings are starting to positively impact margins, as seen by the improvements in the operating margins in Q3. Now, on that front, I'm not blaming the management. I think management is spot on with that, no problem. Now, where the management's bullishness becomes farcical, in my opinion, is with respect to the overall state of the company itself. Management during the most recently concluded earnings call cited ongoing challenges in the global industrial economy, inflationary pressures, and the uncertainty surrounding trade policies, while once again lowering the FY25 guidance. Furthermore, CFO John Dietrich also confirmed that these macro pressures are expected to persist in the first half of FY26. Despite these warnings, both in prepared remarks and during the earnings call, management continued to maintain their stance that long-term profitability would remain intact as a result of Drive and Network 2.0 initiatives. And this is where I struggle to understand. I struggle to understand how these initiatives would offset the macroeconomic challenges. In addition to persistent B2B weakness, macroeconomic uncertainties, there was a new headwind that was added, which is higher inflation. The headwind is realistic given the Trump administration's tariff wars, which tend to be inflationary in nature. I've already covered to you multiple times about it. As such, FedEx now has to deal with more headwinds than before, whereas the offsetting factors remain the same. So you have negatives more, positives same. Clearly, net, it's negative, right? Moreover, the lowered guidance also didn't even take into account the potential impact from reciprocal tariffs, which have gone into effect in April 2nd. Okay, yeah, they've been reversed for a 90-day pause, but the 10% baseline tariff still continues to remain. So nobody really knows after 90 days what's going to happen. After 90 days to what shape or form these tariffs could take. What is clear is that they're likely to be an additional drag on FedEx's guidance, no matter how much positive impact its Drive and Network 2.0 initiatives create. I also want to touch upon the company's European business as well. During the earnings call, there were a lot of positive comments made by the management with respect to Europe. For instance, management mentioned that the company has been grabbing market share in Europe for 7 consecutive quarters, and the segment has also seen improved productivity. These are positive updates, sure, but I don't see how management can point to these factors to justify that the company is doing well. Besides, the transatlantic relationship between the United States and the European Union is at an all-time low, in my opinion, and the EU was one of the major targets of the reciprocal tariffs when they went into effect in April 2nd, before President Trump rolled them back. The attacks on EU have not stopped, by the way. Even though it's a 90-day pause, they still haven't stopped. And so very well likely he could come back with a vengeance when the 90-day period is over. So I find it extremely hard to understand how FedEx's management can justify growth in Europe and at the same time cite tariff uncertainties and inflationary pressures to remain headwinds for the foreseeable future. The only silver lining, if I may say so myself, is that the timeline of the freight spin-off remains on track. The company has set up a separation management office to ensure a smooth transition and completed a $16 billion debt exchange offer as it gears up for a tax-free spin-off of the freight entity. The search for a freight CEO remains on track as well. The segment has had a disappointing quarter as a result of continued weakness in the industrial economy, which resulted in fewer shipments and lower weights. I certainly hope the spin-off transaction is completed on time, as Q3 further justified that investors are better off putting their money in the spun-off entity, which would be under a new leadership. The current management, in my opinion, simply cannot be trusted, as they seem to be living in a pretty different reality. Got my notebook, got my pen. I can only mean one thing. No, not more management criticism, that'll come in later, but it can only mean valuation time. So FedEx, guys. The company now expects FY25 EPS to come in between 18 and 18.60, as opposed to its prior guidance of a range between $19 and $20. It's been a while now since the company keeps citing macroeconomic uncertainties and weakness in the industry economy as reasons for lowering its guidance. This time, one has to factor in the tariff uncertainties as well. I don't see any reason to be optimistic about the company in the near term, and I won't be surprised if management lowers its guidance again. As such, once again, I'm going to assume the lower end of the guidance for my calculations. So FY25 EPS, in my opinion, would come now at $18, which represents a growth rate of 1.1% year over year, pretty much flat. Okay, that's my assumption. FY25 EPS, $18. Now, according to LSEG data, formerly Refinitiv, the company currently trades at a forward price to earnings of 10.4 times. The current multiple is certainly lower than its 5-year historical median multiple of 12.7 and its 10-year historical median multiple of 13.2. When one factors in that the company has lowered its guidance once again, with the lower end of the range translating to an EPS growth of a meager 1.1%, well below its long-term average EPS growth of 14.3%, then the company, in my opinion, deserves to trade at a multiple lower than its historical levels. As such, I have assumed a forward price to earnings of 10.4 for my calculations. So forward price to earnings, 10.4x. According to Seeking Alpha, the company currently trades at a forward price to earnings to growth PEG ratio of 1.24, slightly above its historical 5-year average. At 1.24 and assuming a forward price to earnings of 10.4, the FY26 EPS growth would come in at 8.4%. Highly excessive, in my opinion, given the challenges plaguing the company. According to LSEG data, the market implied EPS growth currently stands at 4.02%, much more reasonable estimate, in my opinion, for FY26. So I've assumed EPS growth of 4.02 EPS growth of 4.02, and that would put FY26 EPS of 18.72. So EPS growth of 4.02%, and that means that the FY26 EPS is $18.72. Now, a forward PE of 10.4, and then you multiply that by 18.72, and you get a price target of $195, which is it's much lower than my previous price target of 258, and it represents a downside of about 4%. The stock has also had a very poor momentum, as evidenced by the D plus grade on the Seeking Alpha momentum scale. The stock is already down 28%, and given the limited downside, despite the weak momentum, shorting the stock is not worth the effort. So I'm going to maintain my hold rating, but ladies and gentlemen, any rise in the stock is an opportunity to sell. Yeah, so I'm going to maintain my hold rating, updated price target of 195, updated price target of 195. Hold rating, momentum grade is D plus. So it's a sell on rally. Any rally you just sell, in my opinion. Just definitely not worth for this. Okay, definitely not worth in this current environment. It's definitely not worth it. For prospective investors, the current condition of FedEx as well as the valuation further confirms the narrative that I raised last time I spoke to you about this company, which is to wait for the freight spin-off to be complete and then invest in the new freight entity than the parent. Bottom line, FedEx had a mixed quarter with a top line beat but a bottom line miss. With an additional headwind in the form of inflationary pressures, management once again lowered its guidance, which has unfortunately become a trend in FY25. While the drive cost-cutting initiative remained on track, the overall business remained under pressure as the macroeconomic backdrop continues to remain challenging. Despite this, management, for some weird reason, continued to remain bullish and struck a confident tone during their prepared remarks. I find this to be absolutely shocking and farcical, as the rationale behind the management's optimism simply doesn't add up. The bullishness on Europe makes absolutely no sense whatsoever, given that the region is expected to face significant headwinds in the coming months, especially once reciprocal tariffs go back into effect. The only silver lining from the quarter was that the timeline of the freight spin-off remained on track. Loop Capital analyst Rick Patterson, someone who I do follow, called FedEx as the stock that you don't want to own if things go down south. In my opinion, Mr. Patterson should have also added management overconfidence as an added reason to not own the stock, which was clearly evident from the Q3 report. That's all the time I have for you this week. Oof, time really flies. I think it was a shorter episode than last time, yeah? But there you go. There you have it, folks. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I should hopefully see you next week. I do have some travel plans that might come up, which might delay the episode by another week. But as things stand, I will see you next week. Until then, stay safe. Don't get too worried about the tariffs and find ways to make some money.